Welcome back to Financial Futures, where we help you navigate the ever-changing world of work, money, and investing. In today's video, we're going to explore how the job market has shifted since 2022 and what that means for you in 2024. The job market we're seeing today is very different from the one in 2022. Back then, employees held most of the power. Quiet quitting, the Great Resignation, it was all about employees leaving for higher salaries. Today, it's a different story. If you're quiet quitting now, you're more likely to get fired, and even those who switch jobs might not see the big pay bumps they once did. So what changed? Back in 2022, employees had the upper hand because there were more job openings than workers. Employers were desperate. Fast forward to 2024, and the power dynamic has evened out. Companies are no longer as desperate, and they've regained control. With that shift, we're seeing stricter policies like mandatory return to office and slower wage growth. Take unemployment, for example. In 2022, the U.S. unemployment rate was at 3.6%. Even through 2023, it stayed steady. But as of today, it's ticked up to 4.1%. While that's still low historically, it's a sign that the job market is tightening. So, why the change? The simple answer: interest rates. Since 2022, the Federal Reserve hiked interest rates to combat inflation. Higher rates mean higher borrowing costs for businesses, leading to layoffs and slower hiring. Many companies are now grappling with debts that have become more expensive, forcing them to cut costs, including reducing their workforce. Goldman Sachs recently reported that consumer spending has slowed to about 2% growth this year, down from over 3% last year. And with consumer spending being a major driver of our economy, this slowdown means businesses are adjusting their forecasts and being more cautious with hiring. Let's talk salaries. Yes, wages have increased between 2019 and 2024, but inflation has outpaced that growth. In fact, household income rose by around 18%, while inflation climbed over 23%. And it doesn't stop there. Housing prices shot up by 67% and cars by 24%. The numbers are clear: while incomes are up, they haven't kept pace with the rising costs of living. More concerning is that wage growth is actually declining. After peaking in 2022, it's been dropping steadily. So even though wages are rising, they're doing so at a slower pace, which impacts your purchasing power. So, what does all this mean for your future? First, job security is more critical than ever. With companies regaining leverage, they're less likely to offer the generous pay raises of the past. Second, if you're thinking about switching jobs, be strategic. Don't expect the same salary hikes you might have seen just a couple of years ago. Finally, if you really want to get ahead financially, it's not just about relying on income. The key is investing. Assets like stocks and real estate have historically grown faster than wages and inflation. So while income growth might be slow, turning that income into investments is how you stay ahead in the long run. Thanks for tuning in to Financial Futures. If you found this video helpful, be sure to hit that like button and subscribe for more insights on how to navigate your financial future. Drop a comment below and let me know how the job market has impacted you in 2024, and as always, I'll see you in the next video.